There is a statement that took me many years to finally believe. The market does not crash because there are too many sellers. It crashes because there are no longer enough buyers. Those two statements sound very similar. But if you understand the difference, the way you look at Bitcoin, stocks, or the entire economy will change completely. The ticker board never lies. It also does not care how many sleepless nights you have spent, or how hard you saved that money. It only reflects one single thing: where the cash flow is going. And all tragedies begin from there. When inflation appears, a lot of people think the problem is just rising prices. No. The thing that is much more dangerous is the cash in everyone's pocket begins to lose purchasing power. You still receive the same salary, but the grocery basket is smaller. The gas tank is more expensive. The electricity bill is longer. Those expenses that seem so small silently drain the investment capacity of millions of people. No one goes bankrupt immediately, but the new cash flow begins to vanish. And that is what the market fears most. A lot of people think Bitcoin drops because of bad news. Actually, the bad news is just an excuse. What the market is reacting to is there is no longer a new cash flow large enough to absorb the selling pressure. The thing that is very real here: when the last person with enough money also begins to stand on the sidelines, the market will lose its gravity on its own. That is when the US dollar strengthens. To most people, it is just an index on a financial news report. But to investment funds, it is a signal to recalculate their entire risk appetite. Money begins to leave highly volatile assets. Not because Bitcoin is worse than yesterday, but because cash suddenly becomes more valuable. High interest rates mean holding cash also generates profit. When that happens, risky assets immediately have to compete to keep capital from leaving. They don't always win. Have you noticed? Every time the market enters a difficult phase, people often ask, what are the sharks doing? I think differently. I don't ask what they are doing. I ask, are they holding cash or are they holding assets? Just by being able to answer that question, you will understand why so many downward cycles happen so similarly. Then comes a moment. A psychological price level is punctured. That number is not important because of itself, but because millions of people believe it is important. The moment that belief shatters, the system begins to react. Leveraged positions are liquidated one after another. New sell orders appear. Not because people want to sell, but because they no longer have a choice. That is a massive difference. When automated liquidation orders trigger en masse, the market is like a mountainside where an avalanche has just occurred. The first pebble is not large, but the further it rolls, the more things it sweeps along. Price drops. Liquidations increase. Liquidations increase. Price drops again. A self-amplifying spiral forms. By that point, the market is no longer falling based on emotion. It is falling based on a mechanism. And right when the crowd thinks this is the end, a very strange thing happens instead. The strongest sellers have already finished selling. The weakest accounts have already left the game. Supply begins to dry up. The spring that has been compressed for many days suddenly enters a state where just a tiny force can make it bounce right back. That is the reason so many major bottoms in history do not appear while people still have hope, but appear after the final hope has just vanished. It is only here that I understand. The sharks do not create the fear. They are only patient enough to stand right where the crowd is forced to sell. Sharks know how to pace themselves according to the macro cash flow. And that is perhaps the biggest difference between the one who controls emotion and the one who is controlled by emotion. In the perpetual futures market, when open interest drops sharply alongside massive liquidations and huge price volatility, it is usually a sign that many positions have been closed or forced out. This can be a signal that leverage pressure has been released, but it does not in itself confirm the market has bottomed. The pacing algorithm, Sharks do not go against the cash flow. There is a misconception that has caused many retail investors to lose money for years. They think, if the sharks want the price to go up, it will go up. If they want it to go down, it will go down. It sounds very logical. But the market has never operated that simply. I used to think the sharks were the ones steering the ship. After many cycles of ups and downs, I finally realized they do not steer the river. They're just very good at moving in the direction the water flows. That is a massive difference. When global cash flow is abundant, interest rates are low, liquidity is constantly being pumped into the economy. Pushing prices up is not too difficult. Because behind it all, there is always new cash flow ready to absorb the assets. But when the macro environment reverses, everything changes. Inflation rises. Interest rates rise. Cash becomes valuable. Funds begin to scale back risk. A portion of capital withdraws from highly volatile assets. At that point, what changes is not the chart. What changes is the lifeblood that feeds the chart. And this is exactly what completely changed the way I look at the sharks. They do not try to fight against the cash flow. They read the cash flow. If liquidity is draining from the market, they have no reason to stand alone and prop up the price. Going against the current, even the largest ship has to pay a price. That is the reason. During many periods of sharp declines, we feel as if the market is falling with no end in sight. In reality, it is not always because someone is actively selling at all costs. A vast number of sell orders appear because systems automatically trigger. Leverage gets liquidated. Margin is no longer sufficient. Trading bots close positions. The further it drops, the more people are forced to sell. A spiral forms. At this point, many people ask me again, so what do the sharks do? The answer is, they wait. They don't need to rush into the middle of a flood. They let the current sweep away the weakest first. That is not cruelty. That is discipline. When selling pressure reaches its absolute limit, a very fascinating phenomenon begins to appear in the market. Those who wanted to sell have mostly sold out. Accounts that used excessive leverage have been liquidated. Cheap supply begins to cluster in a very narrow zone. Right at that moment, large capital begins to manifest more clearly. Not to save the market, but to buy right where the probability of profit is highest. Have you noticed? So many of Bitcoin's sharp rebounds appear right after intense liquidation sessions. Many call it a miracle. I do not. I think it is simply the moment when forced selling pressure has finally dried up. The spring that has been compressed for too long finds its own way to bounce back. But this is where the biggest trap lies. A powerful bounce does not mean the major trend has reversed. If behind that rebound, there is no new cash flow continuing to participate, then many upward moves are just a short-term release of pressure. Just like someone who has just surfaced to catch a breath. It does not mean they have made it back to shore. After many years of observation, I no longer ask the question, how are the sharks manipulating the market? I changed it to a different question. Where is the real cash flow moving toward? And where are the sharks standing within that flow? Just a single change in the question. But sometimes, it determines the difference between a person who is always chasing prices and a person who begins to understand how the market truly operates. The pacing algorithm, when the cash flow tells its own story. There is something very fascinating. Every time Bitcoin rebounds sharply after a crash, the same phrase reappears on social media. The sharks are starting to pump the price. I used to believe that, until I looked closer at the cash flow. A price rebound does not mean the cash flow has returned. Those are two completely different concepts. Prices can rise very quickly. But if there is no one else ready to buy behind it, that upward momentum is usually very fragile. The blindness lies right here. What determines the trend is not the candle, but the one standing behind the candle. After a massive sell-off, the market often exhibits very powerful rebounds. sometimes lasting just a few minutes, sometimes a few hours, even a few days. Those rebounds always create the feeling the bottom is already in. But experienced traders will not look at the first candle. They look at what happens after that candle. If the real cash flow returns, trading volume usually sustains or expands. Multiple asset groups improve together. Liquidity spreads wide. That is a market growing healthier. But if prices rise, while the cash flow fails to keep pace, then the story is completely different. It is like a house that has just had its facade repainted. It looks beautiful, but the foundation is still cracking. Sooner or later, the house must give an answer through its own foundation. The market is the same. A lot of people only see the green on the ticker board. But large capital looks to see how many people are truly accepting to deploy money at the new price level. If the answer is very few, then that rebound has only resolved the emotion. It has not yet resolved the liquidity. There is a detail that I always observe. After very sharp downward sessions, the market typically enters a retesting phase. The price inches up, pulls back down, inches up again, just like someone testing to see how much buying power is still waiting above. If the buying power shows up large enough, a new trend has a chance to form. If not, the market can easily return to the old bottom area to retest one more time. That is also the reason I no longer care too much about are the sharks buying or selling. I care more about a different question. If prices rise today, who is paying for that increase? If the answer is new cash flow, that is a signal worthy of attention. If the answer is merely short positions being forced to close, then I will be much more cautious. And then I realized, what causes many people to lose money is not because they misread the chart, but because they confuse a technical rebound with a real trend. Two things that look very similar, but the consequences are completely different. It is only here that I understand. Large capital does not need to fight against the rules. They only need to patiently stand right where the rules begin to take effect. When real liquidity returns, they move with the market. When liquidity has not yet returned, they are perfectly willing to stand on the sidelines. The sharks do not create the cash flow of the economy. They are just good at reading it, waiting for it, and then amplifying it into a trend. The one who always tries to go against the macro cash flow is not a shark, but usually impatient retail investors. A real trend is not drawn with candles. It is written by cash flow. Have you noticed? Every day, the ticker board has thousands of candles turning green and then red. Every hour, a new trend is declared by someone. But a few hours later, everything reverses again. It was at that moment I realized. The market does not lack candles. The market only lacks a real trend. A lot of people confuse fluctuations with a trend. An upward move of a few percent does not mean the market has stepped into a new cycle. A very powerful rebound is also not guaranteed to signal that a bottom has formed. If behind those candles, there is no real cash flow, then all excitement is very fragile. After many cycles of observation, I discovered something quite fascinating. The market usually does not change trends when people are most optimistic. It also rarely reverses when everyone is still calm enough. The true pivot point often appears when both sides have reached exhaustion. Let's look at the macro context. Inflation rises. Interest rates remain at a high level. Capital becomes cautious. A portion of money withdraws from risky assets. That is when the market lacks not only confidence, it lacks liquidity as well. In such an environment, if prices continue to drop, it is not always because someone is intentionally pushing them down. Sometimes, the market is just following the exact inertia of the cash flow. Leverage gets liquidated. Stop-loss orders trigger one after another. Those who need money must sell. Those who are afraid also sell. The further prices drop, the more the forced selling pressure increases. That spiral amplifies itself. And then, comes a moment. The strangest thing appears. It is not that buying power increases, but rather, selling power begins to dry up. The pivot point lies right there. A lot of people only look to see who is buying, while large capital observes. How many people are still forced to sell? When forced selling pressure gradually ends, the market begins to enter an absorption phase. Cheap supply is progressively transferred to those willing to hold for longer. If new cash flow continues to participate, a solid price foundation will gradually form, not just with a single candle, but through millions of buying and selling decisions occurring within the same price zone. That is when I understood. A sustainable uptrend does not begin with excitement. It begins with the exhaustion of fear. When the ones who needed to sell most have finished selling. When the ones who remain accept to hold. When new cash flow appears more regularly. Only then does the market have a foundation to move up. If at that moment, large institutional capital also enters. If liquidity improves. If support zones are continuously defended. Then the uptrend will be amplified very quickly. At that point, the crowd usually thinks, the sharks are pumping the price. That might be true to an extent. But the more important thing is, they can only do that when real cash flow begins to return. That is what took me many years to understand. A real trend is not created just by a few beautiful candles. Nor is it created just by short-term price pumps. It is formed when three things meet at the exact right time. Macro cash flow begins to shift direction. Forced selling pressure gradually ends. And large capital sees a low risk-to-reward ratio, with profits attractive enough to return. Retail investors usually look at the color of the candle. Large capital looks to see if liquidity is being born or if it is vanishing. When you learn to observe cash flow instead of just observing price, you will begin to see trends that most people only recognize when they are already halfway through the journey. The pacing algorithm, when fake trends deceive the crowd. If the major trend determines where cash flow is accumulated, then short-term fluctuations determine who will keep their money until the end of the game. And this is exactly the art that causes so many investors to lose money. Not because they misread the market, but because they mistake fluctuations for a trend. Does this sound familiar? A very strong green candle appears. Social media is immediately flooded with phrases like, the bottom is in. Uptrend is back. If you don't buy now, you'll miss the entire wave. Just a few hours later, everything turns around. More than a few people look at their red accounts and ask themselves, where did I go wrong? According to my observations, the market often exhibits very beautiful upward moves right when liquidity is still quite thin. That does not always carry a negative meaning. But it is a time when I am particularly cautious. Because when trading volume has not truly improved, a strong price movement is not enough to conclude that the trend has changed. Emotion lies right here. What makes many people excited is not the cash flow, but the color of the candle. They see the price rising, but they forget to look and see how much real money is moving alongside that increase. During such phases, the market easily experiences short but steep upward moves, partly due to thin liquidity, partly due to trading algorithms, partly from short positions being forced to close, and mistake part of it for the FOMO psychology of the crowd. All of it resonating together is enough to create the feeling that a new trend has just begun. But experienced traders will not rush to a conclusion. They usually observe further. Is trading volume expanding? Is cash flow spreading across multiple asset classes? Is liquidity sustained after the initial pump? If the answers are all no, then they understand that the market still needs more time to prove itself. There are very beautiful pumps, but right behind them, new buying power barely appears. That is when the market becomes most fragile. Not because the price has risen, but because there are no longer enough people willing to pay a higher price. When buying power slows down, just a slight increase in selling pressure, and the balance immediately reverses. Late buyers begin to worry. Some cut losses. Some using leverage get liquidated. Selling pressure creates more selling pressure. A familiar spiral repeats. It is only here that I understand. The most dangerous thing is not a red candle, but a green candle that appears right when you want to believe that everything is over. It is that premature hope that sometimes becomes the biggest trap. The market does not need to deceive everyone. It only needs to make enough people mistake a rebound for a new trend. When you learn to observe liquidity instead of just looking at the color of the candle, many miraculous trends will reveal their true nature on their own. Stripping away the green illusion, the market's sweetest trap. If the red illusion terrifies people into panic selling at the bottom, the green illusion is far more dangerous. Because very few die from fear, but a vast number of people lose money because of hope. That is the classic psychological blow. Look closely at it. After a massive drop, the crowd does not expect the market to pump immediately. They only hope that the market stops falling. Just a few green candles appear, and the brain immediately completes the rest of the story on its own. The bottom is in. This time is different. If I don't buy now, I'll miss out. The illusion lies right here. It is not the green candle that creates greed. It is greed that makes people see the green candle as more beautiful than it actually is. If you observe multiple cycles, you will see a repeating phenomenon. The price bounces back quite quickly, but the real cash flow does not increase accordingly. Trading volume does not expand. New capital does not show up. The upward move continues, but it resembles a car coasting down a hill on inertia rather than being pushed by an engine. From the outside, it looks powerful. From the inside, it is quite hollow. The interesting part is, the market rarely stops at a single bounce. It's sideways, sometimes lasting for hours. It is exactly that duration that constitutes the trap. If the price only bounces for 5 minutes and then drops, few people get trapped. But when the green is maintained long enough, skepticism begins to turn into belief. Then belief turns into FOMO. And FOMO turns into long positions appearing more and more at high price zones. By this point, the crowd believes the trend has returned, while those who observe the cash flow look at something else. They don't ask, how much has the price risen? They ask, how much new money has truly entered? If the answer remains insignificant, then that upward move is worth observing rather than chasing. That is also the reason I always look at the chart through 2 layers. The first layer is the color of the candles. The second layer is the weight of the cash flow. There are plenty of green candles, but not every green candle brings real money with it. The final twist is the one to remember. The market does not need to deceive everyone. It only needs to hold the green long enough for the impatient to walk right in on their own. By that time, the trap is complete. The curtain falls when the green begins to run out of breath. If you pay close attention, a fake upward move rarely ends with an immediate drop. It usually dies very slowly. At first, everything is still green. The ticker board is still beautiful. The news is still positive. But a tiny detail begins to shift. The bounce weakens. The upward momentum shortens. Every attempt to push higher takes more time than the last, losing strength right here. A real trend does not die when the price changes color. It dies from the moment cash flow stops feeding it. That is the moment most people overlook. They still see the green, but those who track the cash flow begin to look in a different direction. Is the trading volume still maintained? Is trading volume holding up? Is new capital continuing to enter? Or are there only latecomers buying from those who arrived first? If the answer leans toward the second scenario, then that upward move begins to grow fragile. Then comes a moment when the excitement does not vanish immediately. It only grows smaller, like a fire that is no longer being fed wood. Still bright, but weakening bit by bit. The crowd usually does not realize that, because humans always look at the price first, and only look at the cash flow later. While the market operates in the exact opposite direction. The cash flow shifts direction first. The price is merely the latecomer. By the time new buyers stop appearing in sufficient numbers, everything happens very quickly. A sharp selling wave appears. Then another one. Stop-loss orders begin to trigger. Leverage amplifies the selling pressure. The decline accelerates on its own. Those looking in from the outside often think someone is dumping the price. But sometimes, the market is only reacting to the fact that there are no longer enough people willing to buy at the old price. That is a massive difference. The trap does not lie in the green candle. The trap lies in the fact that people mistake the recovery of price for the recovery of cash flow. Those two things do not always go together. The secret that traders find hardest to exploit. At this point, someone will ask me, if that's the case, then how do you win? My answer is very simple. Don't try to beat the market makers. Stop playing the exact game they want you to play. According to my observations, the market is not afraid of those with a lot of money. Big money can still make mistakes. The market is also not afraid of those who memorize hundreds of technical patterns. Because everyone is looking at the same chart. The hardest thing to exploit is a person who knows how to wait. I call that the mindset of a master mariner. That person does not control the waves, does not fight against the wind, does not try to guess every minor wave. He only does one thing. Reads the direction of the ocean current. If the current has not shifted, he does not weigh anchor. If the wind is not favorable, he does not hoist the sails. Those standing on the shore will say, he is too slow. But when the storm passes, his ship remains intact. That is also what I call the sinusoidal feeling. The market does not move in a straight line. It contracts. It expands. It rises. It rests. It falls. Then it accumulates again. Newcomers always want to trade every single wave. Those who stay long only choose a few waves worth riding. Toward the end of the upward and downward moves, the market does not reward the one who trades the most. It rewards the one who knows how to stand still at the right time. And sometimes, the most profitable trade is precisely the trade you did not open. What is the way to be hardest for the market to exploit? If you ask me, among millions of traders, who is the person from whom it is hardest for the market to take money? I will not answer that it is the one with deep pockets, nor the one who excels at indicators, but it is the one who knows how to disappear at the right time. Disappearing from the game. There is a very fascinating paradox. When you do not open a position, the market can almost never take your money. It is as simple as that. When your account holds only cash, every fluctuation out there is nothing more than rolling waves. Your ship is still safely anchored in the harbor. No one can sink it. A lot of people think, if I don't trade, how do I earn? But they forget one thing. Not losing money is also a form of profit, especially during phases when the market is merely draining everyone's patience. The strange truth is that the market does not reward the one who always has an open position. The market usually rewards the one who knows when not to have a position at all. Colors deceive the eyes. The rhythm speaks the truth. Don't stand in the middle of the battlefield. Don't go full position. Save your money for the true bottom, the true top. Cash is king. Observing long enough, I realized that the majority of losses appear in the exact same place. Not at the top, nor at the bottom, but right in the middle ground, where everyone thinks, maybe this time is right. That is the contested zone. The place where neither the buyers nor the sellers have truly gained the upper hand. And it is also where emotions run the highest. The impatient always want to enter incredibly early. The ones who fear missing out always want to chase incredibly fast. While the disciplined ones accept letting a whole stretch of the road go in exchange for a much clearer entry point. I always like the image of a sniper. He does not shoot often, but every shot has a reason. Traders are the same. You don't need many orders, just the right moment. At this moment, The greatest advantage is not shooting fast, but not pulling the trigger when the target is still unclear. Don't read colors, read the rhythm. This is the lesson that completely changed how I look at the market. In the past, I looked at colors. Green brought excitement. Red brought anxiety. Later on, I looked at the rhythm. A trend does not change within a single candle. It changes very silently. From strong to weak. From fast to slow. From expanding to contracting. The one who looks at colors usually finds out very late. The one who looks at the rhythm usually recognizes it much earlier. That was when I began calling the market by a different name. A living sinusoidal wave of total market capitalization, trading volume, or price bands. No upward rhythm lasts forever. No downward rhythm exists forever. The important thing is not guessing the top or the bottom, but recognizing which way the pendulum is swinging. Toward the end of this rhythm, when you no longer trade based on the color green or the color red, but begin to trade based on the rhythm of the cash flow. The market remains the same old market, but the person pressing the buy and sell buttons is already a completely different human being. Don't look at the candle. Look at the rhythm of the sinusoidal wave. WHO is actually most vulnerable to losing money? There is a question that for many years I have always asked myself. If the market is a giant machine, then from whom does that machine extract money? From the beginners? Not necessarily. From those with little capital? Not either. Through many cycles, I realized the market always seems to prioritize taking money from two types of people. Not because anyone hates them, but because the exact way they trade makes them the easiest targets to exploit. The first type, the ones who only want to make money incredibly fast. They enter the market with a very simple goal. Today must yield a profit. Right now. Right on this very candle. They see the price just bounce and immediately buy. The price just drops and they immediately sell. They do not trade according to a plan. They trade according to the emotion that just surfaced. The irony is that exact type of reaction causes them to constantly buy after everyone else and sell after everyone else. The synchronization lies right here. The market does not need to know who you are. As long as thousands of people react the exact same way, they will automatically form a cluster of liquidity. And wherever liquidity concentrates, massive volatility always follows. The second type, the ones who do not want to think for themselves. This type of person is far more dangerous. They do not read the data. They do not cross-reference signals. They do not observe the cash flow. They only look for a quick answer. Buy or sell? Call a long or a short? Any setups? They hand over their decisions to someone else. And when the decision is wrong, they don't even know why it was wrong. There is a phenomenon I have observed many times. When the market rises a few percent, a vast number of people begin to believe the trend has changed. Not because they verified it, but because the color green makes them feel secure. Meanwhile, the real cash flow might still be very weak. There is one truth. The market does not defeat them with price. The market defeats them with the feeling of certainty. What the market finds hardest to exploit. Conversely, there is a type of person who is very difficult to drag into those loops. They don't try to make money every day. They don't need to trade every hour. They do not fear missing out. They only care about one question. Have the conditions for me to act truly appeared yet? If not, they continue to wait. That is also the reason I call them the master mariner. A person who does not control the waves, only reads the direction of the ocean current. He understands that strong winds are not always the time to hoist the sails. Sometimes, anchoring the ship is the hardest decision of all. Reaching the end of the rhythm. The person who loses the most money is not the one who lacks knowledge, but the one who always believes that they are forced to do something every single time the market moves. What is it that the sharks cannot do? So are the sharks God? No. Sharks also have limits. They cannot create real money. They cannot fight inflation. They cannot fight the economic cycle. They cannot sustain the price forever when cash flow runs dry. They cannot buy if there are no sellers. They cannot sell if there are no buyers. They cannot win every battle. Thus, sharks do not create the ocean. They are just better at swimming than everyone else. The biggest mistake of a newcomer. Thinking our job is to guess what the sharks are doing. In reality, it isn't. Our job is to protect capital. Don't try to be smarter than the market. Don't guess every single candle. Only trade when the probability is high enough. Cash is also a position. Not trading is also trading. The market does not reward the one who trades the most. It only rewards the one who survives. The market has no absolute laws. An increase in volume does not always mean prices will rise. A drop in oil does not always mean a reversal. A rising DXY does not always mean crypto will fall. ETF outflows do not always mean BTC will drop immediately. Therefore, there is no such thing as a holy grail indicator. There only exists a higher probability. Look at the candles from the higher timeframes down to the lower ones. Small candles create noise. Large candles determine the trend. It is true that small waves can deceive the eyes. Only the big waves determine where the ship goes. If you don't see your edge today, then the edge belongs to someone else. Newcomers make money by trading. Professionals make money by waiting. The market does not know who you are. It doesn't care how many times you've been right. It doesn't care that you need money. It doesn't care that you just lost. Perhaps after walking long enough. The market only asks one question. Do you still have capital left to keep playing? Stripping away a new trend of the modern financial market, today. Large institutions no longer rely solely on humans or traditional trading algorithms. They increasingly utilize AI systems and quantitative models to process massive amounts of data. From price, liquidity, and volatility to news and market sentiment. But make no mistake, AI does not create the laws of the market. It only helps to react faster to those laws. The intermarket interconnected basins, the cash flow never lies. The biggest mistake of most traders is thinking crypto can rise on its own, while the whole world is running out of money. No. The global financial market is like interconnected water basins. Just draw from one end, and all the other levels drop. When inflation rises, interest rates rise. The USD strengthens. Money stops looking for profit. Money looks for survival. It withdraws from stocks. It withdraws from crypto. It withdraws from everywhere that carries risk. That is the reason many people see Bitcoin dropping and think the sharks are dumping the price. But very often, the thing that is pulling the market down is not the sharks. It is the gravity of the macro cash flow. When the Nasdaq bleeds, when the S&P 500 constantly loses points, when ETF capital suffers net outflows, when stablecoins are no longer being minted, that is no longer a story unique to crypto. That is when the entire system is lacking oxygen. And the sharks, if they exist, are not foolish enough to fight against that tide. They only do what every surviving player must do. Go where the real cash flow is moving. Don't ask, will Bitcoin go up or down? Ask, where is the cash flow of the entire world running to today? Because price is merely the shadow. The cash flow is the real object. The game-ending protocol, when the spring is compressed to its limit. Now, this is the most terrifying moment. A sharp decline is not when the market is at its weakest, but when everyone thinks it will keep falling forever. After days of sell-offs, leverage has been wiped clean. Weak hands have left the game. Long positions have been liquidated. Short positions begin to pile up. At that point, the market is like a spring compressed to its absolute limit. Just a slight appearance of real buying power. And that spring will bounce. Not because of a miracle, but because below There are barely any people left who want to sell. While above is packed with short positions forced to buy back as the price rises. The very individuals betting on the decline sometimes become the fuel for the next upward move. That is the paradox of the market. The one who thinks they are making money from a trend accidentally creates a new trend. That is the reason the most powerful pumps are usually born right after the most desperate days. And at that exact moment, the majority have sold out completely. They stand on the sidelines, watching the market climb, and ask themselves, why is it rising? The answer is very simple. A trend does not begin when everyone believes. A trend only begins when the market no longer has enough people to fight against it. That is when a new cycle truly unfolds. The permanent upper hand of the experienced. If you have walked with me until the final minutes of this book, what you receive is not a get-rich-quick formula. What is far more precious is a way of looking at the market. Throughout this entire journey, we have not tried to predict every single candle. We have tried to understand why those candles appear. We do not deify the sharks, nor do we believe that every fluctuation is controlled by an invisible hand. But there is one undeniable truth. The market always operates according to cash flow. And the winner is usually the one who knows how to wait for the cash flow to confirm, rather than chasing the emotions of the crowd. That is the reason discipline always stands before technicals. A green candle without strong enough volume is merely an unbacked promise. A vertical pump where cash flow does not tag along is very likely just a brief rebound. Conversely, when the price rises alongside expanding volume, higher timeframes gradually align, and real cash flow begins to return, the probability of a sustainable trend truly emerges. That is not a miracle. That is probability. Newcomers always ask, where will the price go? The experienced only ask, who is truly putting money into the market? Those two questions create two completely different destinies. The inexperienced react to every single candle. The experienced react to the shifting of the cash flow. The crowd always chases the noise. The experienced only listen to the signal. Therefore, your greatest edge is not knowing more patterns than others. The greatest edge is knowing how to do nothing when the probability is not on your side. Staying out of the market is sometimes a position. Holding cash is sometimes an investment decision. Being patient sometimes generates profit. In finance, a vast number of accounts are not lost due to wrong analysis. They are lost because they could not wait. Don't try to win every single fluctuation. Only show up at times when the probability is large enough for the market to pay for your patience. By then, you are no longer someone chasing the market. You are simply calmly walking alongside the cash flow. And that is the permanent upper hand of an experienced individual. I am Sam Success, and this is the most important message of the entire book. The market does not reward the one who guesses right the most. The market rewards the one with enough discipline to only act when the probability is in their favor. Simply put, for the ultra-short-term trend, the 1-hour candle price path moves from the lower band to the upper band or vice versa with a large enough green volume. When the green volume is extremely thin, that is when the price path must reverse. Similarly, for the medium-term and long-term trends, look at the 4-hour candle and the daily candle or higher. Wish you all to soon crystallize your own signs, and always find luck and success.